I do suggest that you grab a pad and pen to jot down any notes, and then as questions come up for you inside of this presentation, just type them into the question bar and I will answer all questions at the end of this presentation. I would like to start by welcoming you to a Peek Beneath the Skin of the Markets webinar series. This is all about enabling educated choices. Today's topic is Financial Crisis 2. You know, certainly one of the most asked questions is when. When will this happen? When will this happen? What I would like to show you today is that the when was really answered back in October of 2008 when the crisis became visible to everybody. At that time, the system, the financial system that we grew up with, was changed forever. That 2008 derivative bubble, when that burst, it killed the financial system that we know. Make no mistake about it, you're going to see it today. Now the central bankers, however, knew this, and so they used the traditional tools that they have, which is basically money printing and interest rate manipulation, to paper over the lie. Because what they know is that if enough time passes from a crisis, people forget. They think that everything is back to normal. They don't realize that everything has changed, let alone anything. And so they choose to leave their wealth vulnerable inside of the system that, as they knew it, never exists. So let me show you what I'm talking about. And I'm going to start with basically in the early 90s. Let me introduce you to the subprime three, Alan Greenspan, Robert Rubin, and Larry Summers. In 1998, they actually blocked the oversight to the derivative market, essentially making sure that it remained outside of the government's level of influence. Now, let me show you why I'm talking about this. Here is the subprime market from the early 90s, or not the subprime, I'm sorry, the derivative market from the early 90s. Now look, there are legitimate reasons why someone would use a derivative. If I'm a farmer and I have to sell in the future, then I will buy futures, which is a derivative, to lock in my pricing in the future. That's a non-trading end-user derivative. But this is what I want you to see, because as you know, derivatives are opaque, complex, they're all about leverage, and they're completely interconnected. These big bets are throughout the global banking system, any of the top financial institutions. It's called a dark market, and that's because by a very wide margin, there's only maybe 4% of these derivatives that are done in exchanges. The rest of them are all over the counter. And thanks to, oops, let me get that laser pen going, but thanks to the work of the subprime three, the ability to have oversight in this market was blocked. Now, I actually find this pretty interesting because just before that and just a little bit after that, the Asian currency crisis was unfolding in like 96, 97, where the Thai baht caused a string, an avalanche of most of the other Asian currencies imploding. That triggered an implosion in Russia, who reset their currency at 1,000 to 1. That triggered a derivative bomb, and some of you may remember this, long-term capital management. And that had to be bailed out with taxpayer money because they were so integrated into the financial system that the powers that be feared that it would take the whole system down. So the interesting part of this is that they blocked this May 7th, 1998, just a few months before the implosion of long-term capital management. And look at, I mean, you can kind of see it from the angle, but look at the trajectory. I'll do it this way. Look at the trajectory of how this market developed. I also want to point this out. that there has been a pattern shift. We're going to come back to that. But you guys know that much of what I'm trying to show you in here is how to recognize patterns, because that always puts you in a better position. Where are we at inside of this trend cycle? So it goes back to that question, when, where. But this rapid rise really is an indication of speculation. And remember too, that these are all derivatives are reported in notional value, which really tells you nothing about the level of leverage or the amount at risk underneath it. And let me just kind of clarify notional for just a second. If you have a $20 bill in your pocket, and 10 years ago you had a $20 bill in your pocket, the notional value of that $20 bill is 20. However, what you could buy 10 years ago, what you can buy today is a completely different beast. And 10 years ago, you had no idea what that $20 bill would buy today. So if you can kind of wrap your mind around this notional value, we really have no idea how big it is. We have some things that we track and can anticipate, but it's huge and can easily take down the entire system. You know, you've seen this chart. I used it recently in the derivatives webinar that I did, but okay, 1999, Larry Summers, one of the subprime three, was instrumental in repealing the Glass-Steagal Act. Now that act was put in place in '33 after that financial crisis, and it kept separate commercial banks that took deposits from investment banks that took risks. When Larry Summers repealed when he got that repealed, he was the Treasury Secretary at that time, that means that the two of them could come together. So here we see this huge run-up in derivatives, whereas for the non-trading derivatives, remember I'm a farmer, okay, that stayed fairly level. These are all speculation, and I want you to pay attention to this pattern, okay? When the derivative bubble burst in 2008, that gave rise to what's called legacy derivatives. So all of these derivatives leading up to this point, okay, typically when a bubble bursts, you get an accommodation after that, a downward movement toward its fundamental value. That is definitely not what you're looking at in this graph. Let me just kind of clarify this, because 77% of the derivatives that are held in the FDIC banking system are all interest rate swaps or interest rate related. Most of those trades are tied to global government bonds. So when that area implodes, it's taking everything down. We have no idea what is really at risk. But the other thing that I want to point out to you on this chart is this shift in pattern, because what would have been normal would be for an adjustment downward. But these derivatives were transferred, and I'm going to show you that in a little bit later, but you don't see the normal pattern. But you do, however, see a shift in the pattern. Whenever there is a shift in normal behavior, it's telling you that something is changing underneath. Do you need to know exactly what that change is going to look like down the road? No. But it should put you on alert that there is a change in the air, and these changes have meaning. They matter. So when that bubble burst, what is the normal response from the central banks? That's to create another one. So I'm going to go back and move you forward a little bit at the same time.